Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is Wednesday, November 27th, 2024, and we're going to talk about the move in income, inflation, and growth. So we got a lot to talk about, and it all came out today in the data. So you can see I've got the chart pulled up here on all the economic data on Forex Factory. We have preliminary GDP, we have core PCE index, we have pending home sales, we have personal income, personal spending. And it's interesting to see how these all feed into each other. So I'm going to highlight a couple things really quickly, and we're going to set up some potential trades as we are watching the market shift. So number one, as we're looking at this, GDP growth is kind of maintained. We're really not speeding up. We're not slowing down. Preliminary GDP is the second report of the GDP reports. Advanced is first, second is preliminary, and third is final. And this is just saying that we're on track of what we thought. So we're growing, but not faster, not slower. So we're not seeing the slowdown, economic slowdown. But as we look at this, we do see slowdown in durable goods, big ticket items. Core durable goods and durable goods both missed. They both fell down and missed expectations. And we had a negative durable good order last month. So we are seeing some slowdowns on big ticket items. So you'd say, okay, so we see that the big ticket items are losing. That means we probably have less money to spend. But this is the interesting thing. This is what I did not expect today, and I took some time going through the details closer, and what we saw is the price index at the same price. So inflation and growth are running at the same rate as what we would have expected. Inflation hotter than growth, but that's also what we should expect. As we look at pending home sales, yeah, that's moving back and forth. This is the key. Personal income, personal spending. We don't usually look too closely at this, but income increased 0.6%. Personal spending didn't. It actually decreased from the previous month. It came in at expectation, but it decreased from the previous month. So we saw an increase in income, but a decrease in spending. This is also confirming what we saw in durable goods orders. So we're seeing this defensive move, this safety play. We're starting to make a little bit more money. We're seeing income grow month over month. We're growing faster in income than we are in inflation month over month, and yet our spending is slowing down. That's a good sign that the consumer is not going to collapse and maybe not going to cause all that default in the credit cards that we've talked about in the weeks past. But it is an indication that we might see this further slowdown as the market goes more and more into defensive plays. And so as I'm watching this, I am looking at defensive sectors, and we've talked about the defensive sectors multiple times, primarily consumer staples, healthcare, and utilities as our top defensive sectors. So let's take a look at the sectors. Specifically, we're going to look at the 3-month rolling quarter and just this last week to see the shift that's going on in this last week. So for the last 3 months, the rolling quarter, S&P is here in the middle, so we're fairly divided, sectors up, sectors down. We have about an 18% increase in consumer discretionary over the last 3 months. Second in line is financials, so we have consumer discretionary, financials, and communications outperforming the last 3 months, and that looks great. That is a healthy economy, possibly. Way down here at the bottom, we look at the 3 weakest. We have healthcare, consumer staples, and basic materials. But that's where we're starting to see the shift. We're not seeing the same kind of behavior. This extreme push high and this extreme push low followed by a recovery that we've wiped out. It dropped all the way down, 10% down to only 5. That's a big 5% recovery in a week. Same thing with consumer staples. So if we change this down to 5 days, 15 minutes, you're going to see the story changes. We look at the top, we have real estate. We'll talk about that in a second. Consumer staples, healthcare, and utilities. Way down here at the bottom, we have technology, communication, and energy. So technology, communication, energy being the lowest for this last week, really giving back some of its gains, dropping just a little bit, but having healthcare, consumer staples, and utilities as well as real estate accelerating 5%. This is a sign of shifting back into defense. And if you don't believe that's a sign of defense, take a look at bonds. Bond prices have found a base, based out for 2 weeks, and now are climbing on good volume. We should be seeing bonds climb up into this 111 to 112 area. And that is what's driving the yields lower. So we're putting all the pieces together, and they're actually in agreement when we're looking at the interest rates falling, which is causing some forward-looking bumps in real estate, we're also seeing that defensive move into consumer staples, healthcare, and utilities. As we're looking at those specific sectors, we could stick to XLV, XLU, and XLP. And you see, this is a very sharp reversal. We've returned back to previous support. We've broken down. So if we get through 151, I expect this to be a V-type reversal that's looking for a move all the way back up to the previous highs. Healthcare was knocked way down, and we can argue that it was because of RFK appointment or other aspects, but the fact is we found a base. We've turned the corner, we found a 6-month low, and we're pushing higher, and we've recovered dramatically off the lows. I've got an expectation of a retest of 150, and again, a break of 150, we should be looking for 160. We could do the same thing for the utilities. Utilities have been setting record highs today, and breaking out, and it's the highest close we've had so far in utilities this year as well. Consumer staples. We are also climbing up, breaking out, pushing through the recent highs. And I would like to see it get through 83. That's our month monkey bar. But I'd like to see it break through 83. And then we really could duplicate this entire move, which is another 5% higher in consumer staples. So if we look at some of the specifics in consumer staples like Kroger, Costco, record highs in Kroger. Costco is near its record high from 3 days ago. Walmart, even though it's not in a pullback or pause the same way the others are, we're pushing to new 52-week highs here in Walmart. All of these are really setting up for a continuation, especially as we go into Black Friday this week and into the holiday shopping. Costco, Walmart, and Kroger are likely to continue to gain. So some of our other stocks like Procter & Gamble and Colgate-Palmolive also are pushing through the highs. We know that they are going to benefit from the defensive play, while the retailers are going to benefit from both the defensive play and the holiday shopping. But all of these are potential breakouts and opportunities to move higher. Procter & Gamble just broke through this pullback. 160 was a pretty decent support. You can see there's a support and a resistance up here. I'm looking for an $18 move on that breakout, which is an additional 10% higher than where we're at. As far as the healthcare sectors go, Johnson & Johnson looks pretty decent, but I like this from a price pattern perspective, that if Merck can break through 103.50, 104, then we're looking for another $10 move. And again, about a 10% move will take this trade from 104, 105 up to 115, back up to this area through here. And I do think Merck is poised to move that next leg higher. Although Bristol-Myers did not get knocked lower, the trend is maintained, and I do like Bristol-Myers for a continuation of this trend. And the trend has been seeing bounces that have been going about 4 to 5% each time it's bounced. As long as we clear this high, we should run another 5% up. For utilities, NextEra has always been one of my favorites for the price action, for the way that it climbs when it does. And we've already filled this gap today and likely completed this reversal. So if we're closing above, and I'm looking for it to close above this high. If we close above 78.80 today or Friday, then I'm looking for this to repeat, which is another $8 move. Guess what? Another 10% recovery. So almost every one of these setups is looking for a 10% move in as few as 2 or 3 weeks, and likely another 10% climb before the end of the year. If they break out and confirm their price patterns, we're looking for another 10% on almost every one of these examples. Where we talked about inflation and growth, let's do this and wrap this up with the discussion of gold versus copper. If what I'm saying is true, that we have a little bit of inflation, we would expect gold to continue to move a little bit higher. We've already put in these record highs. We put in the potential higher lows here. We've been running in these channels. This was the channel rate from back in the summer all the way through October. So now that we've found the base here, we may just chop around through here, slowly climbing up to 2,800 over the next couple of weeks to months, which is fine. But the key here for me is that if we're looking at gold, I want to compare that to copper. If gold is climbing and copper is climbing, then we're saying healthy economy, look for everything to be back into growth. But if copper is not climbing, which it's not, and gold is climbing, that's an indication of stagflation. Inflation is still winning. Growth is not, and therefore we want to be a little bit more protective and keep focusing on these consumer staples, utilities, and healthcare. Right now, today's little tiny bounce at support is a question mark because this is a very strong key support level. If we break through 410, 409, I would want to be very bearish in copper, and I'd be also looking to stay very away from any growth sectors. But if it bounces, great. We can go all the way back, and that'd be about a 10% move here as well. It's all conditional on what happens with copper over the next 2 or 3 days. And at this point, I would rather be in defensive mode and safety, despite the excitement around the holiday shopping. Well, that's going to do it for me today. Have a fantastic, happy Thanksgiving. We will talk to you again Friday live, and otherwise, we'll see you again next week.